Welcome to Banking 101, a first principle jargon-free course on banking. So far, we have developed a qualitative understanding of what banks do. The objective of this lesson is to identify the numbers that best explain what a bank does. If we wanted to understand an airline, we may look at how its revenue is split by leisure versus business customers or domestic versus international travel. Likewise, 4 categories of measures help explain a bank's activities. The first relate to how banks source the funds necessary for their operations. The second relate to how they deploy their funds. The objective of 1 and 2 above is to earn revenues. Hence, the third category of measure relates to the composition of revenues. Finally, all the above 3 require expenses in terms of people and technology. Hence, we will conclude this lesson with an understanding of a bank's expense base. Before we proceed with this lesson, let us take a moment to orient ourselves on where we are in this course. So far, we have developed an understanding of what banks do by learning about the products they sell across the 4 categories of consumer and wholesale banking, asset management and investment banking. In this lesson, we will shift from a qualitative description of banks to a more quantitative approach. Consider a fictional aspiring banker George who is setting up a new bank called Trust Bank. We will assume that the bank plans to fund financial assets worth 100 on its books. To keep it simple, we would not worry on whether it's 100 million or billion. We will scaling everything to 100. To fund assets of 100, George needs to raise capital of 100. There are 3 sources: shareholder capital, deposits and wholesale funds. We will turn to each one of them now. The regulators want George to put 10% of his own money. Otherwise, George will not have any skin in the game. The bank could be making loans recklessly without any financial risk to George. Also, this money will serve as a reserve in case some borrowers default. George cannot fund the entire 10% himself. So, he raises equity from some institutional investors he knows. The shareholders collectively fund 10% of the capital pool to be deployed. Shareholders' capital represents the capital contributed by a bank's owners. This includes the initial capital contribution, any follow-on capital injections as well as profits accumulated over time. The percentage of capital to be funded by shareholders is dictated by regulators to ensure banks have reserves for a rainy day and the owners are not taking excessive risk with other people's money. Now that George has accumulated enough share capital, he is ready to solicit deposits. Deposits can be sourced from individuals or businesses. Deposits provide a cost of funds advantage to banks as they pay a low rate of interest. Depositors are willing to accept low rates because of the lower risk. In exchange for the privilege of acquiring low-cost deposits from the general public, the bank submits to a higher level of regulation. Traditionally, consumer deposits were sourced from the branch, while for wholesale deposits, the bank sales teams chased businesses. But increasingly, deposits are sourced digitally. We will now quickly cover some concepts related to deposits. First, deposits can be interest-bearing or non-interest-bearing. Typically, deposits that offer higher rates have limitations on the ability to withdraw funds. Second, even on non-interest-bearing deposits, banks may offer their customers what is called an earnings credit rate. Instead of paying out interest, the bank calculates an imputed interest rate on balances held in such accounts and gives credit in the form of offsets to service fees incurred on the account. The third concept is deposit beta. When interest rates in an economy increase, banks offer higher rates on their deposits. The converse happens when rates fall. Deposit beta measures the sensitivity of rates offered on deposits by banks in response to change in market rates. For example, if the central bank raises rates by 1% and the bank increases rates by 0.5%, the deposit beta is 50%. Going back to Trust Bank, so far George has raised 10 in shareholder capital and 75 in deposits. But he still has another 15 to go. For this, the bank turns to wholesale funding. One observation here. Since every bank is different, the numbers we are sharing for our fictional bank would look different for different banks. However, the hypothetical numbers for Trust Bank would approximate the profile of large global private sector banks. Wholesale funding refers to debt financing outside deposits. One source of funding is capital markets, where banks can issue debt securities like any other corporate entity. Another source is brokered deposits. These are deposits made by brokers who pool deposits of multiple depositors and place with banks for higher rates than offered to retail depositors. Banks can also borrow from the central bank and other government entities. While deposits are cheaper, banks may rely on wholesale funding if they are having trouble attracting deposits because of increased market competition. Additionally, since banks face restrictions from regulators on the percentage of deposits they can lend, They may use wholesale funding to increase their loan book or finance their investment banking activities. Now that Trust Bank has raised funds, it must deploy the capital in investments that will yield a return greater than its costs of funds. We will now move on to a discussion of how Trust Bank deploys the funds it has raised. Trust Bank deploys the funds raised into three categories: loans, investments in securities, and cash. Parking capital in cash is not productive. Just as we may keep excess cash in a checking account to meet daily expenses and unforeseen emergencies, banks can keep their excess cash in an account with the central bank. But they don't earn much interest on these idle balances. Trust Bank allocates 40% of funds raised to loans, 30% to investments, and the remaining 30% is held as cash. Next, we will dig into loans and investments. As we have discussed in previous lessons, loans can be consumer loans or wholesale loans. Additionally, banks can have credit exposure in their asset management business and investment banking lines of business through products like margin loans, repos, and securities lending. Lending by banks increases the supply of money. Let us see how this happens. Consider three depositors: Tom, Mary, and Alice. Each deposit $100 into their checking account. These three individuals are free to spend this money using checks, debit cards, and electronic wallets. The total money supply is $300. Now, the bank uses part of this money to make two loans of $100 each to two businesses. These businesses can now also spend these funds to meet business expenses. Between the three depositors and two borrowers, now, a total of $500 can be spent. By making these loans, the bank has magically increased the supply of money from $300 to $500. In the previous example, the bank created money of $500 from deposits of $300 by making loans. The reason it can do that is that not all depositors will withdraw their deposits the same time. Think of loans that we take as consumers. A car loan can be for 5 years, a mortgage can be for 30 years. Deposits, on the other hand, are either immediately withdrawable or have much lower mandatory holding periods. If depositors were alarmed that the bank is going to fail and started withdrawing their deposits, the bank will fail. The same thing can happen if a large number of businesses started defaulting on their loans. Hence, there are regulations that limit the percentage of deposits that can be loaned, and as we mentioned earlier, this can force a bank to tap wholesale funding sources. This brings us to the second major use of funds for banks, which is investments in securities. In our earlier lessons on capital markets, we learned about securities and the different types of securities. As we move from left to right, the risk associated with holding the securities increases. The primary type of securities banks hold is debt securities issued by government entities and highly rated corporates. Banks may hold riskier securities for purposes other than investments. For example, an investment bank may have procured shares for the purpose of lending them to a hedge fund client. A bank may find itself owning shares in a company that defaulted on its loan. But the primary purpose of holding these riskier securities is not to generate investment returns for itself. For most banks, securities is their second largest asset allocation after loans. Since these are mostly lower risk debt securities, the yield is low. So, what are the reasons for investing in securities? There are 4 major reasons. Market conditions, liquidity risk management, requirements related to capital markets products and regulations. Next, we will look at each one in turn. The first set of reasons relate to market dynamics. In periods of economic downturn, there simply may not be enough demand for loans from credit-worthy borrowers. Hence, banks invest their surplus deposits in securities. Liquidity is the ability to easily convert an asset to cash. Liquidity risk arises from the fact that loans made by banks are usually of a longer duration than their deposits. Hence, if depositors start withdrawing cash at a faster than anticipated rate, the bank may be out of cash. To manage the risks arising out of the mismatch between the maturity of loans and deposits, banks may invest in securities, which are easier to sell in a cash emergency. Large global banks hold securities to fulfill customer obligations within their investment banking and asset management lines of business. Examples include market making, where the bank holds inventory of securities to fulfill customer orders. Another example is holding securities for securities lending. An investment bank may subscribe to a portion of an IPO to fulfill a firm commitment obligation. Banks may hold securities because of regulations of various types. For instance, there may be restrictions on the percentage of deposits that can be loaned out. Additionally, regulators may require banks to deploy certain percentage of their deposits in securities that can be converted to cash easily. The risks banks face when they make loans or investments are of 2 types: credit risk and market risk. Credit risk is the risk of not getting paid because the borrower is unable or unwilling to repay the principal and interest. Market risk is the risk of losing the value of investment because of market-determined variables like interest rates and foreign exchange rates. When we say that banks invest in lower-risk securities, we are effectively talking of credit risk. But market risk can exist even with zero credit risk. We will explore this concept next. Consider an investor Alice who buys a bond issued by the U.S. government. The credit risk of the U.S. government defaulting on its debt is very low. The face value of the bond is $100 and the investor gets repaid this principal amount in 10 years. The investor is also entitled to interest at 1% per annum, which gets paid at the end of each year she holds the bond. This rate, called the coupon, is fixed. A year passes and now interest rates in the economy have increased. From mortgage lenders to credit card issuers, everybody is demanding higher rates. Alice needs cash and wishes to sell this bond. No one is willing to buy a security that only yields 1% a year. The only way Alice can sell this bond is by selling at a discount to the face value of the bond. For example, if she sells at 95, then effectively she has added $5 to the buyer's returns. When the government redeems the bond on maturity, the buyer gets 100 of principal but the buyer paid only 95. Even if Alice didn't need to sell the bond for cash, she effectively locked up her funds at a lower rate than prevailing market rates. If this investment was made by a bank, this would hurt the bank's profits as the bank would have to pay higher rates on deposits but is stuck with a low-yielding investment for 10 years. We now have a good idea of Trust Bank raises and deploys funds. Fast forward 20 years and Trust Bank has become a large global bank. While the size of its balance sheet grows manyfold, these numbers remain roughly consistent in percentage terms. The entire point of course sourcing capital and deploying capital is to earn revenues. Let us now turn to what Trust Bank's revenue profile looks like after 20 years of expansion. In previous lessons, we became familiar with the product suite of banking. A full-service global bank like Trust Bank earns revenues from a wide array of products. Each of the products that you see on this page has a revenue stream associated with it. Instead of analyzing Trust Bank's revenues from individual products, we will zoom up at the aggregate revenues earned from all products. There are two ways to analyze a bank's revenues. First, we can do a line of business analysis. For instance, assessing how much is generated from consumer banking versus wholesale banking. Second, we can analyze a bank's revenues by the nature of those revenues. For instance, how much is contributed to by interest versus fees. Let us turn to each one. Over the 20 years of its existence, Trust Bank has become a diversified bank with global presence. While its consumer and wholesale businesses are located mostly in North America, it has built a substantial business in investment banking and asset management across the globe. In the beginning years of its existence, Trust Bank was primarily focused on consumer and wholesale banking products. But as it grew, the share of those businesses in its total fell. It was also able to cross-sell its historical products to its investment banking and asset management products. For example, apart from helping raise capital through an IPO, Trust Bank provided a large commercial loan to an electric cars manufacturer. Instead of line of business revenues, we can classify Trust Bank's revenues by the nature of revenues into two categories. First is net interest margin, NIM in short. NIM is the difference between interest earned on loans and investments less interest paid out to depositors and lenders. The second category is fees income earned across different types of services offered to consumers and business. We will now look into each one of them. There are two fundamental business reasons why banks can lend at a higher rate than they can borrow. The first is the yield curve and the second is banks' ability to underwrite risk. Next, we will learn what these terms mean. The yield curve is a graph that maps the interest rates that an investor can earn against the holding period of debt for a given level of credit risk. Usually, longer maturities are associated with our ability to earn higher rates. Consider what happens when we lend to a bank by keeping money in our deposit accounts. We earn very little interest in our checking accounts because we can withdraw funds at any time. On the other hand, if we placed our funds in a term deposit of 3 years, we are likely to earn a higher rate of interest. The yield curve captures this idea by mapping rates earned against hold periods. Banks pay interest rates that reflect shorter maturities on the yield curve as majority of their source of funding are deposits. Demand deposits are equivalent to cash since we can withdraw any time. Even time deposits tend to have holding periods of a few months to 3 years. On the other hand, banks make loans and investments on the longer end of the yield curve. The average tenor of car loans is 6 years. Mortgages can be of 30 years. Banks can invest in government bonds of 10 years. NIM is earned by the bank's ability to arbitrage between the short and long end of the yield curve. If we map the credit rating of banks and their borrowers on a scale, the bank would be usually higher rated than the borrower. Banks make NIM because they are lending to higher risk entities than themselves. This enables them to borrow at a lower rate than they lend at. Of course, if a bank starts making a lot of bad loans, this backfires. Underwriting ability is the ability to accurately assess whether a borrower will repay. It is this capability, in addition to the arbitrage between the short and long ends of the yield curve, which results in NIM. Banks can increase NIM in three ways. One is increase returns on loans. In a competitive marketplace, it is difficult to charge a higher rate than competitors without taking more risk. But a bank can develop a sophisticated underwriting model that allows it to judge risk better than peers. The second way is to increase yield on investments. Since banks mostly invest in low credit risk securities, there may not be much that they can do in terms of getting higher coupons. However, banks can differentiate themselves by managing market risk effectively. A bank that invests in a 10-year fixed-rate bond just when interest rates start rising will not be in good position. Finally, banks can decrease the rate they pay on deposits. However, given market competition, this may not be feasible unless of course the bank does not want more deposits. In periods of economic downturn when banks don't have enough avenues for investment, deposits can be unprofitable. We now turn to fees income. The fees banks charge are of two types. First, there are transactional fees that are charged for routine services. As long as the service provided is secure, accurate and timely, the customer does not have any higher expectations. Fees charged on bank accounts and payments are examples of this. The second type of fees are performance-oriented fees. These are fees for services where there can be a wide range of variation in outcome. An example of this is asset management fees. While the amount of fees charged may not always be contractually linked to a quantifiable outcome, a bank's ability to execute well impacts its pricing power for such fees. This brings us to an interesting question. What determines the NIM versus fee income ratio of a bank? The answer lies in the product mix of the bank. Certain products are more NIM-oriented and other products are more fees-oriented. Let us take a moment to refresh our memories on the banking product suite. We will now attempt to classify these products into NIM and fees-oriented products. But before we do that, we will take a moment to reflect on the fact that many financial products have components of both. Consider a mortgage loan. The lender definitely makes NIM on this. However, when we close a mortgage, we also pay closing fees to the lender. Hence, a mortgage loan has both NIM and fees components. But, by far, the largest stream of income associated with it is NIM. So, we will classify mortgage loan as a NIM-focused product. Next, consider a bank account. The balances held in the bank accounts and the rate that banks pay on them is a big contributor to NIM. However, consumers and businesses may also pay fees for holding the account. Bank accounts are primarily contributors to NIM, though they indirectly contribute to fees via products like payments that are attached to them. Next, consider payments and specifically debit cards, which is a sub-product within payments. Banks earn interchange fees when we use debit cards. But there is no NIM associated with debit card usage. Credit cards is a different story. NIM is earned on those credit card holders who revolve their outstanding balances, while fees income is earned on all transactors. As we now proceed to classify products into NIM versus fees orientation, this discussion illustrates that while we are making thematic generalizations, the distinction is not always black and white. We will now categorize banking products into three categories of NIM, transactional fees and performance fees, beginning with consumer banking. Credit products are NIM. On the cash management side, bank accounts are NIM-oriented. Payments are transaction fees-oriented. Credit cards appear as both a NIM product within credit and a fees product within payments. Next up is wholesale banking. Bank accounts and credit products are NIM. Cash management products including payments, liquidity management and receivables management are fees-oriented. It is worth noting that without the bank account, these fees-generating products will not be possible. Next, we turn to asset management. The asset servicing side of asset management products are both NIM and transaction fees oriented. For instance, idle cash held in brokerage and custody accounts contribute to NIM. Securities financing products also generate NIM. But asset servicers can also generate substantial fees from the same products. While asset servicing fees are transactional in nature, the fees on investment management products are performance-driven. Finally, investment banking products like M&A and capital markets have performance-driven revenue streams. The fees earned by sales and trading desks of investment banks can either be transactional or performance-oriented depending on the complexity of the trades. To keep it simple, we can classify these products as performance fees-oriented. Consider a scenario where someone borrows $1,000 from you with the promise to pay you back with 10% interest within 1 month. Thus, you can make $100 of NIM, assuming your cost of funds is zero. Alternately, someone is willing to pay you $100 to deliver some packages. What would you prefer? The advantage of the second option is that you are not risking $1,000 of principal to earn $100. A lower share of NIM means that the bank is less exposed to credit risks. To carry forward our story, many people can deliver packages. Hence, your ability to charge $100 will compete it away over time. But if your skill is website design, you can earn the same amount of money with less effort and you cannot be outcompeted easily. Hence, a higher share of performance-oriented fees points to a greater competitive advantage of banks. Let us now go back to Trust Bank. At the end of the first year, Trust Bank made most of its revenues through NIM. But by year 10, the ratio of NIM had fallen to 60%. The bank achieved this by selling to businesses, who generate more fees than individuals. However, these fees were transactional. However, George was still not satisfied. Over the next 10 years, Trust Bank grew its asset management and investment banking business, through a combination of organic growth and acquisitions. At the end of 20 years, Trust Bank had a healthy mix of NIM, transactional fees and performance-oriented fees. We began this lesson with looking at how banks source funds, and then we learnt how they deployed funds. The point of all this is to earn revenues. Therefore, we analyze the revenue mix of banks. But raising and deploying capital and selling products requires a bank to incur expenses. We will now complete our banking by numbers lesson with diving into expenses. A bank's expenses can be categorized into two groups. Operating expenses are just that, the cost of operations. It is a broad category that includes everything from salaries to the cost of stationery. Credit losses represent the impact of borrowers not repaying their loan principal or interest. When George looks at Trust Bank's income statement, this is what he sees. About 60% of his revenues are consumed by operating expenses, while another 5% goes towards credit losses. Trust Bank is able to retain 35% of revenues as profits. Let us next dig deeper into these two categories of expenses. Banks have three major categories of operating expenses. The first is people. The second is real estate, including branches as well as corporate offices. The third is technology. Bank technology spend includes hardware and software on a broad range of functional areas. The relative contribution of these three in banks' expenses vary widely by banks. For example, a mobile-only bank may spend little on real estate. While the experience of each bank is different, it is safe to say that the share of technology in the expense base of a bank is likely to increase over time. Credit losses reported by a bank are a blend of two types of information. One is the actual loss incurred. This is the amount of principal and interest that was expected to be paid back but hasn't. The second are anticipated losses. Consider a bank that makes a $10 million loan to a hotel with a 5-year term. The principal is to be paid back in one bullet payment at the end of 5 years. In year 2, a pandemic hits. The bank anticipates that the hotel borrower would not be able to pay 20% of the loan principal. So, it books a loss of $2 million on its books in year 2. This is equivalent to us setting aside money for car repairs because we anticipate our car may break down. Hence, the losses a bank reports in a year could include not just incurred losses, but expected losses in coming years. In year 3 and 4, the pandemic subsides and tourism comes back rapidly. In year 5, the hotel repays the entire loan. The bank now reverses the $2 million reserve it had made in year 2. The purpose of this lesson was to identify the key numbers to look at when analyzing banks. The first set of numbers relate to the percentage contribution of the three major sources of bank funding. The second set of numbers relate to the percentage distribution of assets that banks invest in. The third set of numbers relate to the revenue profile of a bank. We can look at revenues two ways. One by product and the other by type of revenue. The final set of numbers relate to a bank's expense profile. We are at the end of this lesson on banking by numbers. Once you have absorbed the concepts in this lesson, review the summing up section before proceeding to the next lesson.